Markets rallying again yesterday. We've actually had 4 days in a row now of an advancing market after correcting 5% between the beginning of August and the bottom. Here's what you need to know before the bell this morning. Markets rallying again yesterday. We corrected about 5%, came down, retested support going back to mid-June of this year. Bounced off that, cleared the 50 and the 20-day moving average over the last couple of days, have triggered a buy signal. Markets not yet back to more extreme overbought conditions. So again, still some leg here left for this potential rally. Get us back up to around 4,600 on the S&P. Now, as I was saying earlier, September tends to be historically a weak month. However, if you strip out big down years like 2007, others, it's not as bad of a down month. But importantly, when August has had a reversal of the gains in July, then basically September tends to be a positive month, just on average. So again, it's kind of here we are making predictions. Our meteorological prediction for the next 10 days is that the markets may actually kind of try to push up here a little bit. Again, we're not overbought, we're on a buy signal. So the data suggests market momentum still kind of in tow here. It's been pretty much though a driver of those big seven stocks, right? It's money is hiding in those big seven stocks. This is actually something we're touching on in this weekend's newsletter, is that this is really maybe more of a function. The reason that there's so much money flowing into these big mega cap companies is because of the interest service coverage that they have. In other words, there's very little risk of bankruptcy in these big mega cap companies. So for hedge fund managers and mutual funds, et cetera, that need to hide money in a place that's highly liquid and safe in the stock market because they have to be invested, these big mega cap companies have been the place to go. Because if you take a look at, for instance, the Russell 2000, that's where the risk of bankruptcy is. And again, a lot of these small and mid cap companies do not have the interest coverage ratios to actually support the refinancing that's coming up. And there's a big refinancing wall coming up on term loans starting next year and the year after. There's a big ramp up in those. So again, they're going to have to refinance potentially at higher rates. They don't have the interest coverage ratio to cover that, as opposed to the S&P 500, which has had a very nice advance. Small and mid caps have done nothing since October, but that's where the risk is. So money isn't really flowing into these stocks. That's why they continue to underperform, and money keeps kind of all crowding into these very narrow trades. So again, maybe a little bit of something going on, but as big mega cap companies continue to absorb liquidity because it's easy in, it's easy out. You don't have to worry about it, and it's safe. You don't have to worry about bankruptcy risk. That's what you need to know before the bell this morning.